I'm Brian Arcese, one of the multi-counselor portfolio managers on the Foord International Fund and Foord Global Equity Fund here at Foord in Singapore. Today, I have with me Ishreth Hassen and JC Xue, multi-counselor portfolio managers also on our Global Equity Fund, our Asia Ex-Japan Fund, and Ishreth as well on our Sharia Global Equity Fund. Today, we want to talk about our Asia Ex-Japan Fund, which we launched 2.5 years ago, and is now annualizing at positive performance of around 350 or 400 basis points annualized. So JC and Ishreth, thank you both for being here. Maybe JC, maybe you can chat a little bit about the genesis of the fund. We kind of arrived at deciding to launch this Asia Ex-Japan Fund to begin with.
Sure. I think, we have been stock pickers in Asia for quite a while now, since studying Foord in Singapore, and we have looked across global businesses and spent a lot of time actually studying various Asian businesses as well. And we've found that as stock selectors within the Asian universe, we have actually done quite decently well. And then I think the other aspect is that because of COVID, we found that the valuations that we saw in Asian markets was extremely depressed. So in a combination of both our ability to find very attractive names in Asia, as well as our experience finding stocks here, basically are kind of like the gestation of why we decided that it was a good time to launch the Asia Ex-Japan Fund.
Just a question on kind of the fund structure itself, being Asia Ex-Japan. So we do get questions about why not Asia broadly. So why is Japan excluded from an Asia Ex-Japan Fund?
Right. I think part of it is, Japan is a more mature and a developed market, right? So you will find Japan included in global equity benchmarks. You will find Japan included in developed market benchmarks. Whereas, many investors, right, when they think about Asia, they probably want to get exposure to the faster growing Asian markets, right? And that would be Asia outside of Japan. And then from a legacy perspective, we also found that there has actually been many Japan-specific country funds. So there have been investors who were already invested in, a Japan-specific country fund having exposure to Japan, right? So if we had a fund that's Asia that includes Japan, right, that would be call it 15 to 20% more exposure to Japan that some clients might not necessarily want. I think that was kind of like the historic reason of why it's Asia Ex-Japan essentially is for clients to get access to that piece of the Asian pie that's growing at a faster rate versus Japan.
And Ishreth, from a philosophy and process standpoint, maybe you can chat a little bit about either the similarities or the differences, if there are any, between the Asia Ex-Japan Fund and the other funds that you manage.
Sure. I think, from a philosophy and process standpoint, it's pretty much the same thing. We are trying to find value and manage risk as best as we possibly can. But the investment universe is obviously restricted to a much smaller subset within Asia. So I would say that's the only real difference, but everything else on the philosophy side would be exactly the same.
Are there differences in the portfolio construction framework in an Asia Ex-Japan Fund?
Asia as a whole has had a much shorter trading history than most developed markets. There are far fewer companies. And just like with the global funds, we're trying to find the highest quality businesses with the best management teams at very good value. So within the Asian context, they're few and far between, because the universe is quite restricted. So whenever we do come across these types of businesses trading at great prices, we tend to concentrate quite heavily behind them. And even from a sector standpoint, I think the Asian consumer is at a much earlier stage of development compared to the rest of the developed world. So the savings rate is very high, and they're sort of in the early innings of increasing consumption overall. So I think in terms of our exposure to the consumer as well as consumer-facing tech companies, I would say the Asia Ex-Japan Fund would have a higher weighting simply because that's where we see a lot of value and a lot of compounding in the market versus, say, a developed market where you would have a far more diversified sort of exposure base.
Sure. And And when we look at the performance of the fund over the 2.5-year period, which has been quite good, obviously, relative to the benchmark, I mean, the vast majority of that, probably all of it, has been driven by strong stock selection. I mean, how have you, both of you, but maybe Ishreth, you can answer first, just maintained kind of that strong stock selection when looking at a universe that is a bit expanded from what you may have looked at previously?
It's not necessarily too different from what we were doing before, as JC mentioned. I mean, so we break down the world by sectors, and we always have. And what we found out as we were looking through the sectors is that we were finding a lot of value in Asia itself. So even our global funds naturally gravitated to building quite substantial positions within Asia. And one of the drivers was this burgeoning Asian middle class that continues to sort of rise. So as far as the opportunity set, I think it's more going deeper and broader into Asia itself, but we were already there and we sort of understood where the pockets of value were already. Yeah, at least that's my perspective of it.
Sure. And JC, I mean, if you think about that same question, but then maybe also layer on kind of current exposures in the portfolio. So if I look at the portfolio today, it does have a large weighting towards China, for example, particularly relative to the benchmark. So I'm curious if that is a structural kind of weighting that you would expect to be there over the long term, or if that's just simply a byproduct of where you're finding kind of good ideas today.
I think, like, first of all, it's important to emphasize that China overweight, it's a complete bottoms-up kind of stock selection perspective, right? We went to where we saw the most value rather than a top-down kind of country-specific, like, macro bet. Maybe just to give you a bit more perspective of how we ended up with this kind of overweight, right? So if we just take a screen of all the equities within the Asian market and filter out for, high quality businesses with good margins, growth, and strong free cash flow generation, what we would find is that the Indian businesses will be up there, right? Trading at anywhere between 30 to 80 times price to earnings ratio. And then you'll find some of the Chinese names trading at less than 15 times, right? And then if we look at specific names, you would find someone like a DMart, which is a leading retailer in India, trading at 70 times versus a JD.com, which is also a leading retailer in China, trading at 10 times, right? Granted, there are obviously nuances and differences in the growth, runway, and margins and all of that. But what we have found is, when you're paying 10 times for something like a JD, you don't need a lot to go right for the stock to work, right? From our experiences, if you're paying 70 times for something, right, and you get a blip in the growth, right, it can be very dangerous as an equity owner in that piece of business, right? So we followed where we saw the most attractive valuations, right? And in this case, JD is one of our holdings. And then in other times, just coming back to the previous question of, what drove our superior stock selection, right? I have to emphasize that a big part of it comes back to the familiarity that we have built across multiple sectors by the fact that we have covered, the global sectors and global companies for such a long period of time, right? So we were extremely familiar with multiple sectors. Take, for example, Trip.com, which is the largest online travel agency in China. We have been following the online travel agency space for, 6, 7, 8, 9 years now. And we have owned the likes of Booking.com, the likes of TripAdvisor in our global equity fund from various points of time. And so we understand that a business like online travel agency, when you're a dominant market leader, is extremely cash generative, right? And at the same time, online travel agency continues to take share from offline travel agencies, right? So once we put the China COVID environment into context, we looked out 3 to 5 years, and we thought, it's quite unlikely that China would stay locked down for, longer than the 3 to 5 year duration. And if that is the case, then Trip.com, having rebased their cost structure, is likely going to come out of this environment generating very substantial cash flow and strong growth profile, right? So that's essentially kind of what we saw played out. And that's kind of how we think about stock selection piece. So going back to that question, it's really about leveraging that knowledge base that has compounded over the years we have been studying multiple sectors.
Sure. And And recognizing that, I mean, it is helpful to hear that explanation that despite China being sort of a third of the portfolio, that it's really driven by that bottoms up kind of fundamental work for each of the individual names that are included in the portfolio. Maybe Ishreth, if there are other either themes or sectors that would be kind of more prominent in this portfolio relative to a traditional global equity fund, what might they be?
Sure. I mean, I think from a thematic perspective, I think what you would find overwhelmingly across the portfolio is a lot of value. So, I mean, and we don't define value in a traditional sense. It's more sort of a variant perception on how the earnings of these businesses evolve versus what the market expects it today. And as JC mentioned, in terms of China emerging out of COVID and the lockdowns they've had, the macroeconomic backdrop has been quite depressed, and the entire market has sort of shunned many of these businesses today. But I mean, again, if you look at the free cash flow these businesses generate and will continue to generate in the coming years, I mean, going back to sort of where we find that value, it's in sort of the consumer related sectors. So, I mean, for example, we own Yum China, which has the KFC and Pizza Hut as well as a coffee brand all across China, one of the best managed companies there. We own Coupang.com, which is one of the largest the largest e-commerce provider in South Korea. Sea Limited, which owns Shopee across Southeast Asia, is another theme that's prevalent. I mean, we owned this business long before AI became fashionable as it is today, but Baidu is one of the top quality AI technology companies globally. And yeah, so I mean, you'd find the same sort of thematics you would find in the global funds as well in the Asian funds, because again, we're looking at it from a sector bottom-up perspective. So you would expect a fair bit of overlap in sort of the type of ideas and themes you'd find in this portfolio as well.
Yeah. Thank you. I mean, I know it's only been 2.5 years, but it's great to see the adaptation and taking kind of the philosophy, the process, the bottoms-up fundamental work, obviously, that you guys have been doing at Foord for many years, and adapting it to the Asia Ex-Japan Fund. And it's always good to start with strong performance for the 2.5-year period as well. So I know we'll be talking a lot more about it as the years go on. So thank you both.
Thank you.